Okay, can everybody see that? Everybody see that?
I think we're good, Sam.
Okay, hold on one sec, Tarek. I can hear you now. I fixed it.
Yeah.
So we can all hear everybody. Can hear everybody. That's good. At least me and you can. All right. So is everybody ready? Yay! Tarek, thank you very much for doing this. Everybody, we are here to be educated by one of the, in my view, definitely one of the most intelligent people when it comes to money and financing. Excellent, excellent. He's my advisor and deals with financing, educates me on how the lenders are dealing with financing now. There's nobody better, in my view, to help us learn this and understand it better. And a great teacher, I'll tell you that too. But anyways, so his name is Tarek Soufan. We'll talk about how you can, if you have additional questions, how you can reach him at the end. Right now, I want him to take over and just be good students, ask questions, and let him go through this material. Thank you, Tarek.
You're very welcome, Sam. Just one thing, Sam. I can hear my echo through your speakers.
Oh, can you? Okay, hold on one
Yeah.
sec. I know why. I think. Let's see. Not there anymore.
Let's see now. Oh, yeah, still a little bit there.
It's because, Tarek, you're hearing me. Do you know what you do, Tarek? Can you mute me on your end? I don't think you can. So how bad is it, Tarek? Can we work with it? This is the thing,
Yeah,
Tarek. I'm not gonna speak when you speak, okay? So we should be okay.
okay. I think that sounds better. Yeah, that sounds better, Sam.
Excellent.
Okay, could you do me a favor, Sam? Can you flip over to the next page? Now, there's a way that you can display all three pages on one page. I think if you maximize the Word document, you should be able to see all three. Yeah, there. Well, that's fine. We can leave it. We can leave it like that for now. Yeah, that's perfect. And then just maybe go to the next page. Yeah, let's start with that. Um, okay, so just to change things up a little bit, I usually go through this point by point, but what I'd like to do tonight is just open it up to you guys. And we've got 6 different areas that we'd like to talk about and discuss tonight. But before I get into each area, is there any specific area that you guys want to tackle tonight? Um, that's, maybe you're working on something right now and and maybe you're stuck on a deal, or maybe there's something that you're not quite understanding. Is there any area from this document here that that you want to speak to specifically tonight? And maybe we can start off with that, and then we'll go through the rest of the points.
Jump in, Tarek, right now concerning the question about rent to own. Why don't we hold that until we're done with the financing? Because the financing really, the rent to own is outside that. Does that make sense?
Sounds good.
Okay. Okay, good. All right. So Tarek, let's see. We have a question on financing
And then maybe
commercial.
send a copy of this document out to everybody as well. Then.
Just want to let everybody know I'm going to give you a copy of this sheet that Tarek's provided to us at the end. Okay.
Now, Sam, do I have the ability to access this document as well?
No, not the way I got it set up you're on my screen.
Okay.
But let me see, Tarek, if I could get you to. Uh, no, just tell me.
That's fine. If you want, just go back to the first page and we'll dive right in.
Is that where you want to be?
Yeah, that works for now. Yeah, we can start off with that. Okay, so I guess so obviously we'll start off with point number one. So traditional mortgage lenders in Canada are your banks, your credit unions. Some people don't know that credit unions also offer mortgages, insurance companies as well. So I work for an insurance company. I work for London Life, and a lot of our business is residential mortgages. Manulife also does mortgages. Your mortgage brokers and then your private lenders. If you have a relationship with a financial advisor, I would say that that would be your first go-to source for mortgages, just because they've sort of got their finger on the pulse of the mortgage market in the city, right? So, I mean, for example, if you came to me for a mortgage, I'd look at the deal and then I would determine whether or not this is a deal that the insurance company would do, or a mortgage broker or a bank directly, and sometimes even private lenders. But if you've got a relationship with the financial advisor, I would definitely suggest that you talk to him before you kind of venture out on your own for a mortgage. Then your mortgage insurers, Genworth and CMHC are the ones that usually are thought of first. There is a third insurer in Canada called Canada Guarantee. These insurance companies provide default insurance. So what happens is if you get it if you get a mortgage in Canada and you're paying less than 20%, you have to insure the mortgage, otherwise the lender won't do the deal for you. So anybody paying less than 20% pays a fee to one of these three insurers, and then basically that mortgage is guaranteed by the insurance company to pay out the bank should you default. And there's a link to the three websites there. Click those links and get to know the different services and the different programs these insurers offer. I've seen many instances where a bank will turn down a client. The client will contact the insurance company. The insurance company may grant an exception for the deal, and then the client sees a mortgage broker, and through the mortgage broker, they're able to obtain the insurance and get the deal done. Okay, there's some questions here, so I'll go ahead and answer those as well, Sam. These insurers are in all provinces, correct? Yes. So these insurances are Canada-wide. CMHC is the main one. Genworth is probably the second biggest. They do a lot of self-declared earnings deals, so they do a lot of self-employed people. Voice cut off. I think that's for Sam. Can you guys still hear me?
The links are not live on the screen,
Yeah. Okay.
folks. You're gonna have to wait till I give you this file, but I'll give it to you. Okay? Don't worry. Everybody will get it at the end.
Okay. Okay. So let me just read some of these questions. Okay. Okay, so just Ricky in Edmonton. I applied for a larger HELOC and they want to charge me $400. Just to quickly answer that, anytime there's a new lien, they have to register a lien at City Hall on your property, so there is a legal fee for that. Any other questions here? No. Okay, looks like we're good. So get to know those three insurers. Those are the only ones in Canada. They provide the default insurance. Click the links when Sam sends you the file, and just get to learn all the different programs available. Because sometimes the guy working at the bank doesn't have all the information, and you can contact these companies directly and kind of state your case to them. The third area of interest tonight that we'll be talking about are the 5 C's of lending. These are the main areas, these are the main criteria that lenders look at for any sort of financing, whether it be financing for a car, financing for a loan, a line of credit, and mortgages as well. So those 5 C's of credit are capital, collateral, capacity, which include GDSR, TDSR, character, and credit worthiness. So just to touch on each point individually. So capital refers to basically what you're worth. So how much money do you have, um, for the deal? So are you putting down $50,000? Do you have money in the bank? Is there equity somewhere? What is your capital? What are you bringing to the table? Collateral are your assets. So maybe you've got a home, maybe you've got some cars, maybe you've got some jewelry. What is the source of collateral? Should you default on the mortgage, the lender wants to know that there's some sort of collateral. Traditionally, with mortgages, the house is the collateral. With auto financing, the car is the collateral. Capacity is your ability to service the debt, and the areas that they look at under capacity. There's a couple of ratios that all banks follow, and the numbers are pretty much standard across the board, whether it be from an insurance company, a bank, credit union, and even the private lenders. And those ratios are listed just below that. And we'll touch on that in a bit. The other area that they look at is your character. So what do you do for a living? How long have you been at your job? Have you declared bankruptcy or had a consumer proposal in the past? They want to see that that you've been with your employer for a certain amount of years, et cetera, et cetera. So character, just because you've got good credit and you've got income, doesn't mean that you're going to get your mortgage, right? So, I mean, somebody who's 19 years old could have great credit and great income. That doesn't mean they're going to get approved for a mortgage, right? Most Canadians, when they first get their first credit card, they've got impeccable credit scores. But one credit card for $1,000 and a $40,000 year job doesn't guarantee you a mortgage. So they're looking to see that that you've been in the workforce for a few years, you've got a few different credit cards, maybe a loan in the past, and that usually satisfies their character requirement. Credit worthiness is one of the other main areas. So they're looking for a minimum score usually of 640. You can see your credit score. Later, I touch on some of the different rating agencies, but you should have, I mean, all Canadians now have the ability to get their credit score instantly at no cost, and it gives them a good indication of where they stand with their credit score. So those are the 5 C's of lending. We'll come back to gross debt service ratio and total debt service ratio because those are very important. Those are calculations that you should be doing on your own before you walk into a bank so you're not wasting your time and you're not wasting the lender's time. And once you have these numbers in your head or written down and you understand them and you've satisfied the minimum requirements of these ratios, then you should be able to get approved for your mortgage or for your lending purposes. So I'll go over that with you, and I'll make sure that everybody kind of understands that and understands how to calculate this percentage. It's basically it's a ratio of your income to debt, pretty much, right? So your debt's as a ratio of your gross income. They don't look at your net income; they look at your gross income. Sam, if you can go to the next page for me. Okay, so point 4 is the credit reporting agencies. So you've got Equifax and TransUnion, and then you've got their affiliate sites that monitor those credit agencies. So if you go to creditkarma.ca, that'll give you a credit score either on Equifax or TransUnion. I think Credit Karma, I think it's TransUnion, and I think Borrowwell is Equifax. But anybody can go there and check and pretty quickly get all their information. Mortgage underwriting is another area that we should talk about. Mortgage underwriting is the process of an underwriter basically reviewing the file, making sure that everything is in line to support the mortgage application. And this is where a lot of people run into problems, especially self-employed people. There's a specific income verification process that underwriters look for or ask of the borrower. So when they're looking for proof of income, I mean, some lenders might just ask for a job letter, last 2 pay stubs. Most lenders nowadays ask for a lot more than just a job letter and or last 2 pay stubs. They'll want to see your notice of assessments. They may ask for T4. They may ask for your bank statement showing the income going into your account. It all depends on how you're earning your income. But this is an area of concern for a lot of people because not everybody has their notice of assessments handy. So they may be scrambling last minute to get that, et cetera, et cetera. So you want to understand the whole underwriting process so that if you're walking into the bank and you've got your ratios in line and you know your credit score is good, what are you bringing to the table to verify your income, right? So as long as you have those in order and you're able to satisfy the criteria, you should be good to go. If you're self-employed, they may ask for 3 years notice of assessments and T1 generals just to show the source of the income. Sometimes if they ask for bank statements and not necessarily pay stubs, they'll see your net income go into the account versus a pay stub which shows you both your net and your gross. So that could be to your advantage or disadvantage. Some banks will gross up the net income by a flat 30 or 40%. So depending on where you go, it might be advantageous for you just to bring your bank statements showing the pay going in versus an actual pay stub. But we'll get into more details of that later in the conversation. Down payment rules. I spoke with a client today that did a deal through Scotiabank, and typically what a lender should ask for is the last 90 days bank statements showing your down payment in the account. That's a rule that's been set up through CMHC as well as the Government of Canada for anti-money laundering rules. The client that I spoke with today borrowed the money on a secured line of credit and used that as a down payment on the house, and I couldn't understand how it slipped through the cracks through Scotiabank, but apparently it did. So I mean, sometimes with the point is traditionally they want to see your down payment in the account for the last 90 days, and they want to know the source. And it shouldn't be borrowed funds. It should be money that you saved or that was gifted to you by somebody that's not asking for it back. So, and then everything else in regards to providing proof and credit score analysis, property assessment, that all comes with the deal as well. So property assessment just means, is it on MLS? Can they see the listing? They need to see basically the information regarding the property. So you could have everything in line. If the property is garbage in a bad area and it's got a history of, I don't know, being run down or it's had problems growing marijuana, they may not approve the deal. So the property is also a concern for the underwriter. It's not just the deal, it's the property as well. What does the collateral look like, right? And lastly, mortgage programs. So what that entails is different programs that the insurance companies offer for different types of um, different types of clientele. So you could have one client who's a hairdresser, for example, makes $80,000 a year, but they're only showing $30,000 or $40,000 income. Or a construction worker making $80,000 a year, after deductions and tools, he's only showing $20,000 or $30,000. Well, mortgage lenders and the insurers are aware that these people can make a lot more money, but they're just not declaring all their income. So they've created programs to address that. They call it the Alt-A program. It's done through Genworth. So if you're a commission-based agent or you're in an industry where you're able to hide your wages, maybe a waitress earning tips, as long as the income that you're declaring is reasonable for your job, they'll accept that as income verification. So somebody bringing in a notice of assessment showing $30,000 of income, but states they make 80, like a construction worker, as long as their credit is good and they bring a big enough down payment, they'll let a deal like that go through using this program. All right, so there's all these types of programs. There's programs for newcomers to Canada that have no credit. You just have to become familiar with them, and unfortunately, not all the people working at the banks or the credit unions are aware of all the programs available through the insurance company. So sometimes, a mortgage broker is the better way to go because they're aware of all these different programs. So a mortgage broker is going to get all types of clientele. They're going to get the people that have no money, bad income, and they know how to make the deals work. Whereas the bank traditionally gets the tier A or first tier type of clientele. So the advisor at the bank might not have all the information needed to get the harder deals done. Again, that's where the expertise of the financial advisor may come into play, or a mortgage broker as well. Okay, so those are the six main areas that we're going to touch on tonight. Is there a specific area that you guys want to tackle first, just in case we don't have time to go through it all? Okay, let's get a consensus here. So we got Letty who wants to talk about capacity. That's a big one, so we'll touch on that. And then insurance companies. What's the difference between these insurance and those from the bank? Okay, foreclosures versus bank. Okay, so let's touch on the first two for now. What's the difference between these insurance and those from the bank? So the banks are using the same insurers. The banks, the mortgage brokers, the credit unions, anybody lending on residential mortgages in Canada can choose between those three insurers listed. Those are the only three in Canada that offer default insurance. Now, that doesn't mean you have to purchase default insurance. So for those people looking to put down 20% or more, the lender may choose to pay for the default insurance out of their own pocket. Those are the three insurers, and each one charges a different fee based on the amount of down payment you bring to the table. So somebody bringing 15% down payment will pay a smaller fee than somebody paying a 5% down payment. So a 5% down payment, they may charge you a fee of 4% on the entire amount borrowed. So if you're borrowing $500,000, you could pay $20,000 in CMHC fees if you're only putting down 5%. Versus somebody putting down 15%, they may pay 2% CMHC fee or default insurance fee. Okay, so is everybody clear on that? Okay, so let's tackle capacity, and then we'll get to some more of these questions here.
Just 1 second. Can everybody hear okay? Because Sanjay,
Yes.
you keep saying that you can't hear. Is everybody hearing okay? Is it clear? Yeah, I thought so. That might be on your end then, Sanjay. Just wanted to maybe log in and out. Maybe it might help. I'm not sure what's causing that, but I think the consensus is the voice is coming in clear. So you might want.
So Mona at a GTA, when it says banks usually offer their own insurance too, could you just expand on that? What do you mean they offer their own insurance? Are you talking like mortgage insurance? Like mortgage life insurance, or what is it you're referring to? Yeah, mortgage life insurance is a whole other beast, right? So that's basically life insurance. That's a life insurance contract, is what that is. Right. So if husband and wife purchase a property and they die, the life insurance company will pay the balance of the mortgage. That's different than defaulting on a mortgage. And then Mariam in New Brunswick, CMHC is not just in the province of Quebec. No, CMHC is Canada-wide. Okay. So once Sam sends you the document there, you guys can click those links and just familiarize yourself with the three different insurers. That way you've got all the information. It won't take you long, and it'll really help you in the future with any of your lending. So next we're going to touch upon the gross debt service ratios and total debt service ratio. So if well, we've got an example right here listed actually, so this might work out for us. Let me just get my calculator.
Let's hold the questions. Let's hold the questions until he goes through this example, and then you can ask them. Okay.
Okay, so we're going to go through the two ratios that lenders look at. So basically, the computer qualifies you. Once the computer qualifies you, they're able to send this deal off to the underwriter for review. So before they even get to an application, they're going to ask you some simple questions. The first question they're going to ask you is, what is your income? So for the sake of this illustration, what do we have here? So we have a gross income of $150,000. So that's on one side of the ratio. Then we're going to calculate the the areas of debt that make up the debt portion of the ratio. So you've got income on one side, and then you've got debt on the other side for the gross debt service ratio. The gross debt service ratio is the first ratio. If you pass this one, or if you meet the criteria on this one, then there's a second stress test, which is the TDSR that they're going to qualify you on. Sam, we've lost the document there.
Yeah, I know, Tark. I'm just seeing if maybe it's better on a whiteboard, and I could just follow for you. Is that better, or would you like to go back to the example?
No, we can use the whiteboard. That's fine. I've got the Word file in front of me as well, so I can refer to that. So let's. Are you able to
Just
draw
tell
on
me
the
what
whiteboard
to
for
write.
us,
Go
Sam?
ahead.
Okay, so let's put income $150,000.
150.
Right. And the reason why I'm stressing this, guys, is because the three main areas of criteria when when a lender wants to qualify you for a mortgage is your credit score and the two ratios, GDSR and TDSR. Once those are qualified, they'll look at your character, they'll look at your collateral, they'll look at the property, they'll look at your income verification, they'll look at all the other stuff. But if you can't get this part right first, then there's no sense of moving forward, because the lender will disqualify you if these stress tests aren't met. So they may make exceptions on your character. They may make exceptions on the property. They may give you a break on down payment as long as you're there with a minimum of 5%. But they cannot make exceptions on the ratios because they're mandated by the government. Right. So I want you guys to understand these ratios and do one on yourself, just to kind of give you an idea of what you qualify for. Okay. Okay, Sam. So you've got the $150,000 income. Let's take a look at the debt portion. So, client walks into the office, wants a $750,000 mortgage. Let's say the interest rate is 3%. So you've got a mortgage payment of $3,006, Sam. So if you can just put that in a different column or underneath,
mortgage
and we'll tally up
is how much?
It's going to be $36,000 a year. So put $36,000.
Okay.
Property tax is $600 a month, so we're going to put property tax $7,200.
Okay.
And we're going to put heat $1,200
for heat. Okay.
Heat. Okay. Now, if you've had condo fees, that would also get bundled in here with the debts. These are the only debts a lender looks at for this specific ratio. They don't care about your credit cards or car payments or student loans for this ratio. They just want to make sure that if you had no other debt, are you able to afford your mortgage, your property tax, and your heating bill?
The TDSR, right?
This is GDSR. This is your gross debt service ratio. This is not total debt. This is just gross debt. Okay? So if we add up the numbers, let me just do that here. Mortgage. So Sam, what do you got up top there? What's the M?
The M is the mortgage of $750. That's what you told me, right?
Where are you getting that? No, 3,000. The mortgage payment is 3,000.
Yep, I got that for the mortgage payment, but the total mortgage is $750,000, isn't it? And the interest is 3%, right?
Yeah, my apologies.
Okay.
Perfect. Yep. Okay. So we got 36,000 a year, 7,200. So you got 43, 44, 4. So if you can just put 44,000 as your total debt, and then we'll divide it. So we'll divide. So put down 29.3%.
Tarek, the calculation just for me, I'm seeing 36,000 plus 7,200 plus 1,200, right? So 36,000 plus 1,200. That's the thing, and 7,200 is 44,400. My apologies, I put 44,400. Okay, so $44,400 per year, and we divide that by 12 to get the monthly, right?
No, you're just dividing that by the 150.
Oh,
so you've got gross income of 150,000. You've got gross debt of 44,400.
So I'm dividing this 44,400 by the income to see the percentage it's going to take up, right?
You're dividing, you're dividing the debt by the income. So this is a ratio of debt to income. This is a debt to income ratio.
So I got 29.6%. Okay. Does everybody get that? Everybody follow what we just did?
So what we're saying here is that 29% of your income is being utilized by your mortgage, your property tax, and your heat. So this is fine. As long as the number is less than 32%, the lender will move forward with the next batch of criteria. Right? If you can't get this part, if you're over 34, and in some instances 39, and I'll explain that later, you can't move forward. So the maximum is 39, but even to get to 39, there's some exceptions. So typically, I tell people between 32 and 34, depending on the lender, is usually the max. So if you're 34 and under, expect that you'll be able to move forward on the deal. Okay, everybody. So it's just basically your debt as a ratio
Does
of
everybody
your income.
understand that?
And as long as it's less than 34,
Okay. Is there any
you can move
questions
forward.
before he moves on? Just before we go
Right?
move on. Does anybody have any questions about how this was calculated? So we had a mortgage of $750,000. The interest rate was 3%. They're trying to calculate if you can afford to buy this property. So the mortgage payment's going to be $3,600 a year. Your property taxes are $7,200 a year, and your heat is $1,200 a year. This is what they're going to add all together to see how much of that money, that cost, is going to take away from that gross income of $150,000. So when we take the $150,000 and we look at how much we're paying, $44,400, we divide the $44,400 by 150 to tell the lender how much of your income is going to be eaten up by this mortgage. In this case, it's 29.6%. GDSR is looking at gross numbers, and it's saying that, look, as long as you're under, what Tarek's saying is, as long as you're under 32%, no problem. You've met the commitment of GDSR as the first, test of your ability to manage this debt, the service of the debt on this property. We're good to go. We can move on. There are exceptions at 34 and 39 that Tarek's going to speak to. But right now, does everybody understand what we're saying? Yes?
Okay, and I'll answer those other questions in a minute here as well, guys. So just before we get to those questions about the max and is the mortgage payment included with interest, let me just touch on the 32 and 34. So some lenders are 32, some lenders are 34. The 39% example is the following. So I had a client come into to our branch. They weren't approved for a mortgage. They were a little bit over 34. They were actually at 38% GDSR. But what the client did is he put down 20%, and then he offered to pay the CMHC out of his own pocket. So do you remember how I told you before, if you're paying a 20% down payment or greater, you don't have to pay CMHC? Well, typically what happens is the lender covers the CMHC fee because the lender still wants the default insurance. They'll pay a premium to have that insurance in case of an accident. It just means that you don't have to pay it. Well, in this case, the lender didn't want to pay it, so the client offered to pay the CMHC even after the 20% down payment. This allowed CMHC to increase the GDSR from 34 to 39. So because CMHC approved the deal, the lender approved the deal. Okay, so if you ever run into a situation where you want to go to 39% GDSR, as long as you put down more than 20% and are willing to pay the CMHC fee of about 1.5%, you can get the deal done. But most Canadians don't have 20% down payment, so in most cases it doesn't qualify. So some of the questions is GDSR max 32%. So it's 32, 34 at most banks and lenders. You can go up as high as 39 with that circumstance that I just mentioned. Prabin had a question. Mortgage payment is included with interest. Yes, that is correct. So that mortgage payment of $3,600 a year, that is the mortgage payment including interest. Now, there has been some changes made to that mortgage amount recently. So, as of last year, actually, I'm using the actual mortgage payment for this illustration, which is inaccurate. So now what they're forcing lenders to do is they're forcing them to use a fictitious higher mortgage payment to make sure that you're able to handle it. So if you have an interest rate of 3% on a 5-year mortgage and your mortgage payment is 3,600, well maybe you qualify here. But Sam, can you go ahead and change the mortgage payment from 3,600 to
The mortgage
5,000?
payment? Okay, sure.
Yeah, just for the illustration, I want to just illustrate something. So when I change it to 5,000, this is a fictitious amount. But what the lender is forced to do now is they're forced to use the posted interest rate and not the actual interest rate. So the posted interest rate is around 5% right now. So they want to make sure if the interest rates are raised to 5%, can you handle it? So if the interest rates are raised to 5%, this mortgage now becomes $5,000 a month. At $5,000 a month, this person doesn't qualify. 2 years ago, they would have used the $3,600 as the qualifying mortgage payment because that is the actual payment. Now, they're saying, nope, you want to make sure that you can afford even 2% higher. So this is why less people from Toronto and Vancouver are able to buy houses than they used to. So there's a softening in real estate markets in Vancouver and Toronto, and a lot of it has to do with this new stress test. They don't care that you can afford your payment. Can you afford a higher payment? Can you afford a payment that's 2% higher than the mortgage that you're buying today? Is that clear?
Okay, everybody, I just want to make sure everybody understands this mortgage payment is $36,000. My apologies, I put 3,600. And what Tarek is saying is they're going to test you at 5%, the posted rate, instead of the interest rate they can actually give you, which would be 50,000. And if we use 50,000, right, plus 7,200 for taxes, plus 1,200.
60, yeah, 5,000 a month.
What's that, Tarek?
So 5,000 a month would be
Oh, I'm
60,000.
sorry, 5,000 a month. Yeah, it would be 60. Yeah. So 5,000 a month would be 60,000. I'm sorry. So 60,000 plus 7,200 for taxes plus 1,200. Now we're up to 68,400. Now we're not this anymore. We're 68,400. Well, that's going to create a problem, right? Well, not necessarily a problem, but it's going to change this number. This number now becomes 45.6%. Now we got a problem.
Yeah.
Right?
Yeah,
Does
we got a
everybody
big
see
problem.
that? Yeah, so now it's breached. It's breached all three limits, 32, 34, and 39. And Tarek's making the point, which is 100% accurate. This is was specifically done to slow down the real estate market, to bring down prices, purposely done by the government. And it also tells us that the government's concerned about interest rates going up. They want to have the ability to move interest rates up, but they can't, with the current mortgage rate. So they basically prepared us for possible increases of interest rates in the future. Does everybody understand that? So
So I just want to answer some of the questions here. So Atlantic, Enrica, and Edmonton are asking, is heating the same as utilities? No, heating is separate. So heating is your gas bill if you've got central air. They don't care about your hydro and water. And hydro and water is usually $300 or $400 a month. I get that. That's not factored into GDSR. The only thing they care about is heat. So, as long as your house is heated, they don't care if you can't afford your hydro. Right? Now, the only other number that would be included in GDSR is condo fees if you were purchasing a condo. So for those buying apartments or townhouses, if there's condo fees, you got to throw that into the calculation. How does rental income figured? We'll touch on that later when we talk about income verification. Timothy, let's see here. What's the rate at 20% down? So Emmanuel, expand on that. Okay, so for CMHC, roughly, if you're putting down 20%, I'm pretty sure it's in and around 1% of the deal. So, but you don't have to pay that. So, Emmanuel, if you're walking into a lender's office and you're putting down 20% down payment, they'll cover the CMHC fee. You don't have to pay it. Okay, unless you're short and you can't meet this GDSR requirement and you want to go as high as 39%, then they'll make you pay it. But it's roughly 1%. Let's take a look here. Okay, I think we can move forward to TDSR. So now, once you've satisfied that first component that we talked about, GDSR, the next ratio they're going to look at is TDSR. So, Sam, if you could bring up that page again, we're going to add a few more numbers.
You want a whiteboard? Okay.
Yeah.
So we're gonna go back to whiteboard. Hold on 1 second.
And we'll use the same number. So $150,000 of income between husband and wife, the $750,000 mortgage, and we'll use the original GDSR. So TDSR is a function of GDSR with a few more additions.
Okay, so 150 income, property price, mortgage is going to be 750. Okay,
Yep.
interest
Interest is
is
still
still
3%.
3%. Okay, and then
Mortgage payment is 36,000 a
36K
year.
a year.
Actually, you know what? Just sorry, erase that. Just put GDSR. Erase that bottom part. Just put GDSR and whatever the amount was, 44,
Okay, so
42 or whatever it was. Do you remember what the amount was that we had?
GDSR was 44,400.
400. Yeah. Okay. Perfect. And then just to the top right, Sammy, just put TDSR.
TDSR.
And now we have to add all the other revolving debt. So what does that include? That includes credit cards, lines of credit, loans, payday loans, car payments, student loans, any debt that's reported on your credit bureau forms part of the TDSR calculation. So for the sake of this scenario, Sam, let's put one credit card, one car payment, and that's it. Let's just do one credit card and
So
one car
credit
payment.
card, how much?
Okay. So a credit card will have a balance of 10,000. Car payment 350 a month. And then lastly, just do PLC, so a personal line of credit, and put 25,000. Okay, so the same way we figured out what the payments are for heating and for property tax and for mortgage payment, we got to figure out what the payments are for your credit cards, your line of credit, and your car payments monthly. So if you've got a $10,000 credit card, what number do you think the lender is using for your monthly payment? Anybody want to take a stab at it? Just type it out there.
Sorry, say that again. My apologies.
Yeah. So Emmanuel got it right. They're using 3% of the balance. So if you've got a $10,000 credit card and we're trying to determine what your monthly payment is, it's 3% of the balance monthly. So typically the minimum payment on a $10,000 credit card would be, let's say it's $150 a month. For the sake of this total debt service ratio, they're going to use 3% of the balance. So 3% of 10,000 is $300. So they're going to want to see $300 a month come out of your bank account to pay off this credit card. That's what they're going to use for this example. So if you just want to mark $300 beside that,
let's I'm gonna run on this space here, but see, let's have credit card, 300.
Yeah, just do 300
per month.
Yeah. Your car payment is as it is. So if you've got $350 on a car payment, that's the monthly payment. They're not gonna round that up or down. That's the payment they'll use. Personal line of credit. This is where it gets a little bit. This is where there's some variation. Some lenders will say 1%. Some will say as high as 3%. So for the sake of this example, we're going to go 3%. So you're looking at another $750 a month. They don't care what the actual rate is on your credit card or your line of credit. They're doing 3% of the balance. So you could be in a situation where you've got an amazing rate on your line of credit. Maybe it's only 5% a year. That's irrelevant. They're going to use 3% of the balance. Okay, so if we add up 750 and 650, you're looking at another $1,400. Times that by 12 and add it to the GDSR, and that serves as a function of your income, and it gives us a number. So Sam, I'm just going to do the math here, unless you've got your calculator handy. You got a calculator handy, Sam? Just do 1,400 times 12.
How much was it? It was 1,400 times.
Okay, so Charles,
16,800.
Yeah, add that to the 44.4. What does it give us?
So let me just do this. So I got, give me one sec. GDSR was 44.
So you got
or the
and then TDSR Is
was
61.2.
16,800.
61.2? No, just put 61,200, Sam. They
60,
already did the
sorry.
math for us.
Oh, total. Total is how much?
Yeah,
200. Okay.
61,200. Okay, and then divide that
Divide
by your
that. So we
150.
have income 150 divided by 61. That's the other way around. Dividing the 6120 by income equals how much?
Okay, so Lucy's did the math for us. We're at 40.8%. So this deal works. This still works under the old stress test rules. Under the new stress test rules, because we're using a higher payment, a higher mortgage payment, this isn't going to fly. All right, but just to give you an idea, somebody making $150,000 a year with typical debt, it's hard for them to borrow $750,000, right? So maybe you kind of come in there with a $200,000 down payment. That makes the deal work. All right, but if we go by the
Does
old
everybody
stress test
understand what
rules,
Tarek just explained?
this
You
this
know,
deal
because
this deal
the
works.
down payment, and that's where the down payment changes the numbers, right? Because if you have a down payment, it takes away from the cost of the whole mortgage, right? And if it takes away from the cost of the whole mortgage, obviously you can afford more, right?
Where's your payment done?
Because you can only afford what you can afford. You can't afford what you can't afford. So they're saying the maximum you can afford, and this is where the bank would pre-approve you, right? A lender would pre-approve you and say, well, this person can go out and get a $750,000 property, or this person can get a $350,000 property. This is based on the understanding that if you were stress tested against the loan for that property, you would pre-qualify. You would qualify. That's where the pre-qualification comes in. So by adding more money down, you've basically reduced the total cost of the mortgage, which will allow you to maybe be qualified or not qualified based on that extra money that you're putting in. Where you're talking about what we're trying to do and how we're trying to do it. At the end of the day, this is how the institutions want to see the loan. It's up to us to structure our investing if we're going to meet the requirement for these particular institutions to find a way to make the numbers work so they can give us what we want. Now, we don't have to stay with that after. Once the loan's been issued, there's lots of things we can do. But to meet the requirement, and this is why this lesson is so important, and understanding this, the math is not hidden. We understand this is how they're going to qualify, people, and this is what your mortgage broker would do for rent to own, right? With people with tenant buyers, they're basically saying based on the tenant buyer's income, based on what they have, this is what I can qualify them for. It's the same concept. So this is very, very enlightening to understand, what parts of this can we change or modify or manipulate in the best and most legal way. When I say that, obviously, but so we can meet the requirements of the lender. Go ahead, Tarek. Sorry, I wanted to share.
No, that's it. You've touched on all the points that I was going to touch on, Sam. So thanks for that. Okay, so what we discussed here is basically if you walk into a lender's office and they want to pre-qualify for your home, they're not necessarily going to pull out your credit bureau and ask you to bring in all this documentation. They're going to ask these simple questions, make sure you qualify under GDSR and TDSR, and say, here's the number. This is what you can afford based on this new rate. And then you go out there and you find a property for that in and around that range, up or down depending on your down payment. And then at that point, they'll run your credit check. And as long as your credit's good and you've got a decent job and you've got a couple of years behind you, things will fly. Now, just because you have pre-approval doesn't guarantee you that the underwriter is going to commit to the deal. So maybe you've passed the GDSR, TDSR, maybe they don't like the property, maybe there's no job security, many things can impact the deal. So a pre-approval isn't always guaranteed that you're going to necessarily get a deal done. So if you're ever looking to purchase a home, just because you've been pre-approved doesn't mean you have to waive the financing clause. Always have an out, always have a financing clause in there that gives you 5 days to go out and get a not just a pre-approval, but an actual ink on the deal.
Great point.
That. Right? Let's just get to some of the questions. What is max TDSR? Max TDSR is in and around 44%. I've never seen it go higher than that. So, I mean, if you're on the private lending side, they may have different numbers, but anything CMHC or with default insurance, 44 is the maximum I've seen. How much was the maximum ratio of TDSR? So that's the same question. It's 44%. What happens when there are multiple properties involved? So when there are multiple properties involved, the hope is those other properties have additional rental income, and that rental income increases your own income. So if you have $150,000 of income from your job, and then you're collecting $2,000 a month from a rental property, half of your rental income will be counted as income for the deal. Some lenders, depending on where you go to, could include all the rental income as your own income. Most of them will just use half. So you're bringing in $2,000 a month on a property, they'll say, okay, $1,000 of that is usable on this side of your income. Could I repeat that? What is it you're asking about the financing clause? Oh, so whenever you're purchasing a property, you always have some conditions in the deal, maybe condition of a home inspection, condition of two follow-up walkthroughs, and you have a financing condition. So the financing condition basically allows you 5 days or 7 days or whatever the amount of that condition includes. So it could be 7 days typically. It gives you 7 days to go and get a deal approved. So you walk into your bank, they give you a pre-approval, you go out, you shop, you find a home, you like it, you throw a condition, your realtor will put a condition in the contract that states you've got 5 or 7 days to get suitable financing. And then you take the deal to the bank and they approve the deal. So that just gives you the time to get the actual deal approved, because the lender still has to pull your credit, which they don't do for pre-approvals most of the time. They still have to look at your income verification documents, and they have to look at the property. And that takes time. So if you don't include a financing clause and then you take this deal to the bank and they don't like the property, or you don't have enough income verification documentation and you don't get approved, then you're on the hook. So having that clause in there allows you to leave the contract without any
Okay, folks,
recourse.
we've ran long here. I really appreciate Tarek spending this extra time. I put up the file, the mortgage financing T-Doc right there. Just have to download it. Can everybody do that now? You can download the file that we're just looking at.
I'm just going to answer Carol's question real quick here, Sam. Is there any way to work around poor credit? And the answer is yes, Carol. A mortgage broker will work around poor credit. There's lots of ways to be creative with that.
One area that we didn't get to talk about, and I'll invite Tarek back, is the options with using your RSPs and your TFSAs, having the opportunity to access that money for your investing, and how you can continue to invest in the market and invest in real estate at the same time, and the benefits of that. We'll have to do that at another time. We can't do that tonight. So I want everybody to download the file now. Everybody download the file. And I know there's a couple more questions here, but you know what? I don't know, Tarek, let's see. What about financing? Okay, we got that. Is there a way to work around poor credit? Tarek, you can answer that. Oh, my apologies.
Yeah, I've answered that. You can a mortgage broker will work with poor credit. That's not a problem.
It's not 9:30 Eastern? What do you mean? It sure is 9:30. It's 9:36 Eastern. We ran long. Does everybody have the file? Does anybody need more time? Because what I want to do is can you put in the Dropbox, please? It's already there. Yeah, it starts at 8:30 and we finish at 9:30. I have this session starts at 9. No, Dwayne, we moved it. We moved it to 9:30. But it is going to be recorded and posted, folks. It'll be posted. Don't worry, you can all review this. I'll post it up tonight, okay? I'll post this one. I'll get up right away. Okay, so does anybody need more time with the mortgage financing download? Has everybody got that? Tarek, I'm just going to get you to hold on just one more minute if you could. Private lending can get CMHC. Sure. Yes, private lending. Anybody can get CMHC. Lenders can get CMHC. Yeah. Got it. Good. Okay. So what I'm going to do is I'm going to stop the recording for a moment. Okay, we're done the recording. Don't anybody leave. I'm going to stop the recording for this. This session is now officially over. Okay, hold on.